Hi, Niro Pillay here from Investment Rise. And in this video, I want to talk about rental yields. How do you calculate them and what do they mean? Why do I believe rental yields are so important in 2017 and for the coming few years? Well, we've just come off a time of record low interest rates, and even though the RBA hasn't moved, a lot of the banks are increasing their rates, especially for investors. And I do believe that eventually the RBA will have to increase their rates, although that may not be until 2018 based on some of the research I've done at the moment. So that being the case, if interest rates rise, rental yields is going to become more and more important from a cash flow perspective. So let's look at how we work out rental yields to begin with. And I've done an example here just so that we can go through the figures a little bit more quickly. Imagine a purchase price in Sydney of $1,300,000, which is just a little bit above the median price point. The rent on that be around about $750 a week. And if that seems low, I'll verify in a moment why I think it's actually a little bit high for that sort of property. So let's keep going though. So rent per week, $750. So if we go annual rent, so multiply by 52, that works out to be $39,000. Okay, so how do we work out the yield? Well, the rental yield is the annual rent, AR, divided by the purchase price, which in this case is $39,000 divided by 1.3 million, which works out to be 3%. Now, the average rental yield in Sydney at the moment, sitting at about 2.6 to 2.8, and that's the average. It's a lot lower in many areas right now. So if your yield is so low, well, what does that mean? I mean, why do you care? The first thing is interest rates at the moment. For an investment loan at the moment, yes, loans have increased, but they're still low. We're looking around about 4.25%. If your rental yield is 3%, but your interest rate is 4.25%, you're already behind the eight ball, especially if you're borrowing 80% or 90%. And what happens if interest rates rise? Sure, you get a little bit back in negative gearing, get a little bit back in depreciation, yes, but ultimately, you are going to be behind the eight ball from a cash flow perspective. And as interest rates rise, you will find it harder to keep funding that property. And people say, oh, sure, but just increase the rents. Okay, well, let's look at that. Let's say you were going to increase the rental yield from 3% to 4%. Sounds like a 1% increase. What's the big deal? Well, let's look at the numbers. A 4% rental yield means that on a $1.3 million property, you'd be getting $52,000 per annum in rent, or $1,000 per week. Now consider this. How likely is it that the family, your tenants, who are paying $750 a week or $39,000 per annum, could very quickly increase those payments to $1,000 or $52,000 per annum? It's highly unlikely. Remember, this is after-tax dollars, so here for $39,000, someone's going to earn, depending on which tax rate they're on, over 50 grand at least. And on if they're going to then pay you sort of $52,000, the earnings are around about $70,000. See, so it's highly unlikely that you're going to get this steep increase from $39,000 to $52,000. Therefore, the cash flow position is going to be tougher. Now picture this. Instead, where let's just say we look at a purchase price of $500,000. And of course, if you're looking at a house for that price, you're not looking in Sydney or Melbourne. All right. So $500,000, and look, on that kind of property, we can definitely get your rents of, say, around about $480 per week. So that works out annual rent to be $24,960. or 4.9% rental yield. Look at a 4.9% rental yield. If your interest rate is about 4.25, you're ahead of the game. So you've already got some buffer if interest rates rise. And then look at, if the rent's only $480 per week, increasing it to $500 or $520 isn't a big deal from a tenant's perspective over time, but it's certainly going to help you with your cash flow. So one of the things I'm really looking at for people who want to invest in property in 2017 is, number one, yes, do all your research, with infrastructure and all those capital growth drivers, that absolutely, you got to do your research there, because capital growth still is your ultimate goal as an investor. But then one of your new criteria has to be rental yields. I believe if you're not getting a rental yield of at least 4% or higher, you really should be double checking whether you should be going ahead with that investment property. And I'm just showing you how to do the rental yields. Now, of course, if you are on a very, very high income and you can afford the cash shortfall, fantastic, great. And it can be in the order of hundreds of dollars, sometimes even $1,000. I saw one client come to me who had a property in the northern suburbs of Sydney, and their cash outflow every month was $1,700. Sure, they were getting good capital growth, but it hurt them while they held the property. So if you can handle that kind of cash shortfall, fantastic. But if not, add this criteria into your investing. Look for rental yields of 4% or higher in areas that are have good capital growth drivers. And then I think you're going to find yourself have a much better chance of success and really enjoy the next phase of investing, which is the next few years where we're going into a higher interest rate time. Let me know what you think about adding rental yields as part of your criteria for choosing investment property. I'd love to hear from you. Bye for now.